Mish. Welcome to another Monday after quite a week last week. Let's start out by looking at the S&P 500 since everybody's focused on the S&P 500, and you and I were talking about some of the similarities between now and 2023. So let's dive into that first.
Okay. Well, yeah, because obviously the question on everybody's lips right now is, did we see the bottom this last week in SPY and in the market in general? And I think you have two camps, probably more in the camp of, yeah, it was the bottom. I know particularly I was watching Larry Williams over the weekend and he's like, the bottom is in. And it's possible. So that's why we thought, rather than give you a yes or a no, we should look at a comparison of when there was a bottom and what it looks like now. So Jeff's got a chart up here for you looking at October, November time in 2023. And of course, we know that 2022 was obviously a very bad year. In 2023, things got up and down, up and down. And then finally, we had that sell off at the end of the year. And what happened during that time is we had the classic reversal. Now, we don't have volume on this chart, but I did a daily on this so you can look at the volume there to see that the volume on this move down was tremendous. And subsequently, the volume on the move up was tremendous. And we'll talk about that when we get to present time in a moment. And we also had the 200-day moving average, which is green, super close. We had the 50-day moving average, blue, super close. We had the 6-month calendar range low, which in that case would have been the July one, super close. And then not too far above that, we had the 6-month calendar range high. Not quite a convergence, but darn close. So it was pretty obvious, even if you missed the reversal. When you got through the 200, you had your first phase change. Even if you weren't convinced because you wanted to clear the 50, you had your second phase change and clearing the calendar range low. And then you had the gap, a couple of days of digestion, and then boom, it cleared the 6-month calendar range. And maybe that's when you got in. But one thing we saw during that time was high volume. Jeff is pointing out the real motion. We had real motion have a mean reversion, and then across the 50, and then across the 200 and the Bollinger Band. So momentum was in gear. That was a true bottom. And of course, if you look right, you can see that not only was it a good bottom, it was a sustained bottom until the peak that we've just seen recently in March of 2025. So let's scooch over to that more.
Okay. Um, come on. Sorry, my machine's slow.
Okay,
Yeah.
so yeah. So now look at the difference. Remember, we showed you all the same four indicators we have here: the 200, the 6-month calendar range low, the 50, and the 6-month calendar range high, and real motion. Look at the difference here. First of all, let's start with real motion, Jeff, because we pointed this out once before. It's in a bearish divergence. Look where the 200 is. It's above the 50. And even though we got a little bit of a better momentum today, and nothing to write home about. We're not even near a mean reversion, number one. And number two is what we don't have again is the volume patterns. The last couple of days of volume has not been great like it was in 2023. So that right away, you're kind of like, wow, okay, momentum is not really wowing us here. Now, if you look at the price, we did have a legitimate new 60 plus day low last week. Then we had the reversal pattern where it closed above the high of the previous day. We got the follow through today. So here's where the jury is out. Besides the momentum, which would make me more skeptical than optimistic, but still, you never know, would have to clear the 200. It would have to clear the 6-month calendar range low. So now we're at 575. And then maybe you can get a pop up to the 50-day moving average, which looks like it's at around 590, 585, 590. And then the 6-month calendar range, which is about 600. Now, I'm not suggesting you have to wait for that. But what I'm saying is, if it doesn't happen, then you know this was just kind of a bull trap, or I wouldn't call it a bear market rally, but at least you could see the phase in the SPY has been a distribution. So it's kind of like a very anxious bear market rally. And and it would turn over either today's high or the 6-month calendar range low at 575. We don't know. If it though, I would at least want to see two things before I would get more excited, and I would want to see it at least clear the 200 and the 6-month calendar range lows since they're so close. So maybe we get a close over 575. I'd say take a shot. You know right away where you're wrong if it starts to break down under that 6-month calendar range low and the 200 again. So you have a minimal risk, right, Geoff?
Yeah, for sure.
Okay. Now, we wanted to start with this because obviously equities are what most people talk about. Buy the dip is, something we hear all over the media. And very little do we hear anything about commodities, and particularly, except for gold. Obviously, everybody's talking about gold. So we wanted to show you a couple of things in the commodities world. Let's start with sugar since I wrote about it.
I'm going to say one more
Oh,
thing,
please, please.
because this is something we do that I always do in the weekly mentoring as a really simple way to capture a move that you think has reversed, and you want a really easy way to kind of double check it. And that is you're always looking at the last bar's low. And so you said it, Mish, you said if you get through this area, you know that you've got to stop if you get back down under the 200. So if you take that and then you also look at has the market traded below the prior day's low, and that's your stop. And if you want to be a little bit more um, sophisticated about it, then it has to break yesterday's low and the opening range. If you look at markets that just kind of trend and go, they never spend any time over the prior day's range if they're going down, below the prior day's low if they're going up. And when they start doing that, that's when you get choppy. I mean, even look from the high, if you just look at the prior day's low, you don't break it. Like right here, you did, but by a fraction, didn't break it here. Here you opened higher, but you didn't take an opening range low. You didn't hear, 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 you didn't hear until Friday. So
Mhm.
basically that rule kind of kept you on the right side. And I'm saying reverse the rule, and you might find a situation like you had over here without taking too much time, all the way up there, all the way up there, all the way up there, pretty much all the way up there. It's a really stupid, simple rule, but when you know how to use it, it's really effective. I do it all the time in the Wednesday session. So combine that with what you said with the levels, and that's all you need. Let's go to gold. What was it, gold or sugar? Where do you want to start?
Sugar, sugar.
All right.
So while he's getting the sugar up, I can talk. So those of you who know my work know that I talk about, I love sayings, right? Economic modern family, trifecta of inflation would be another one, vanity trade. I've coined all these phrases, just waiting for them to go viral. So help me out. But anyway, in the trifecta of inflation, we know the first one is the silver to gold, and we're going to look at that in a moment. We know the second one is the dollar. Well, it's sitting right on 103. We're not going to look at that. Just take my word for it. The third is always sugar. And people say to me, why sugar? Well, one is because nobody ever talks about it. That's number one. Number two is it really is an incredible barometer for a lot of different things. It's a barometer for weather. It's a barometer for geopolitics. It's a barometer for even local social stress. It really is something that's in everything. It's a comfort food. And even though there's a lot of bad press about sugar, it's still a very reliable barometer for all those reasons. Plus, since I'm, as old as a vampire, I can tell you that I know from sugar days back in the day, sugar was the first thing to rally in 76. It went to 65 cents a pound. And then in 79, it started its rally just as gold and silver did, and it peaked out at like 45 cents. And that was the hyperinflation. So what I'm looking at right here is not necessarily hyperinflation, but a really good indicator of whether or not inflation is going to pick up, whether or not the tariffs are going to have a negative impact, whether we're going more to stagflation. And of course, if it turns back down, possibly a great indication of real recession coming. Right now, to me, it's looking strong. Exactly the opposite of what we just saw in SPY. It's above everything. It's above the 200, it's above the 50, it's above the calendar ranges. If you look at the leadership, it's outperforming the SPY. If you look at the momentum, by the way, in a bullish divergence because there the 50 is over the 200, where on the price chart, the 50 is still underneath the 200. So you have that bullish divergence, you see the momentum growing, and we basically stopped right around the most recent highs, which was 1276. Today's high, I think, was 1272. So to me, not only is this in some ways showing a lot of strength as an opportunity for investing, but it's also telling a story that SPY may or may not go up. And Jeff and I were talking about this before, and he could probably say it better than I. But commodities, particularly if you find the right ones, are definitely looking interesting.
Yeah, I mean, the way I was putting it is this same thing. It's just that these commodities could go up if stocks go up. They could go up if stocks go down. And if stocks go down for the right reasons, like say it's inflation fears, then that could be the reason that these things go up. So it's kind of like 2 out of 3 scenarios, this can go up.
Right. And you know what, also what strikes me kind of interesting, I wouldn't necessarily say this is any kind of statistical fact by any means, but we had a huge rally in cocoa followed by a huge rally in coffee. And now, of course, both of those have calmed down, which also is the nature of commodities, but it does seem like sugar might be next. So there you go.
Definitely got that basing that basing look. And you said this, and as you said it, I couldn't zoom out like this. But if you look at the real motion divergence here, you have where's my pen? You have the cross of the 50 and the 200 here ahead of this. And then when sugar pulls all the way back to the lows, the real motion just comes back to sit on the 200, and the 50 never trades below it, and now they're both going up. I mean, that's a really nice looking, sloppy but nice looking bullish divergence, especially with the retracement to the 200 while the price action hits a new low.
The only thing I would add to that is because this is an ETF, you have to look at the underlying futures. And right now, sugar's trading right under 20 cents. 20 cents is very pivotal. If you read my daily, you'll see why.
Yeah.
Should we go to DBA now? Because
Let's do that.
it's got everything. So this way we don't have to go individually into corn and wheat and coffee and cocoa and lumber and all that stuff, because it really does sort of include a lot, maybe not lumber, but it does include all the agriculturals. So I think this chart, we can spread
Zoom.
this out a little bit. Yeah. So again, we had a major sell-off in the market. You saw that SPY broke down under the calendar ranges and all the moving averages. But look at DBA. Sure, it sold off from the highs, but it held that 6-month calendar range low, and it held the 200-day moving average, which is much lower. And also, even though it had a momentum situation right now, look at where it is on the Bollinger Band sitting right there, which means to me that any kind of push will get this momentum back over that 200-day. But going back to price, Jeff, this is something you and I did a few weeks ago where we talked about the lineup of the 50-day moving average and the 6-month calendar range high. Remember?
Yeah, yeah.
There's your signal, folks. If we get a close above there or 2 closes above there, if you need more confirmation, that to me looks like another great opportunity. Again, using Jeff's rule with that same kind of risk.
Yeah, and also look for the real motion to close over its 50. I wouldn't necessarily wait. But if you move over in price and this doesn't move over, then you might be quicker to get out. But if they both move over, that's even more confidence.
And it is outperforming the SPY.
Yeah, it looks
Yeah.
good.
So,
And
this is commodities talk. Jeff, Keith, and I were all commodities traders. So for us, this is kind of exciting.
yeah, it looks good. It
Yeah.
looks good.
So let's
So
go
here,
on to let's change topics a little bit here. Let's go to lithium. It's
oh,
a little interesting story with LIT from personally. So, all right, I'll tell the story while you're looking at the chart. So, I was looking at lithium. So, sometimes, kind of consumer instincts sort of sits in, and we're hearing a lot more about the ultimate clean energy, of course, is nuclear energy, and lithium is definitely a part of that. And then there was a whole story on CBS Sunday Morning, not just on nuclear energy one day, but then they had another story up over the weekend about another type of using nuclear energy. I can't remember exactly what it was, but it's been coming up a lot, right? We know that Amazon has made huge investments into getting nuclear energy potentially going because they're going to need it for all the electricity needs with the big data centers. So I started looking at LIT. And then over the weekend, I go sometimes to listen to what Helene Meisler says. She's been around a long time, so I have a lot of respect for her. And all of a sudden, she was talking about look like lithium might have bottomed. And I thought, okay, sometimes when you think it, and then somebody you really like says it, you go, aha. So I had one of those aha moments. So I started looking at the chart today, but I didn't buy it because it needs a little bit more proof. So remember, we just talked about, well, that's a nice trend line, and it lines up perfectly. So again, the market sold off, this barely budged, held the 6-month calendar range low, is over outperforming the benchmark. In terms of the actual real motion, today it crossed back over the 50. And look at the convergence of the 50 and the 200, which is so interesting because it looked like it might have gone into a death cross. It's just like in line with each other right now, the 50, the 200. So that means to me, the 6-month calendar range and that trend line that Geoff drew in is really the place. And I think if I get a move and a close over that 6-month calendar range, again, you've got a pretty good risk. Maybe with this, I might go under that 6-month calendar range low just because we had so much price action around it.
Yeah,
That
that's a lot of support.
that's a lot of support. I wouldn't want to risk for anything higher than that. I would want to give it some room. And as you know, if you're going to give something a $2 kind of room, that you just adjust your position side according to whatever you're trading with. So keep an eye. I'm very keen on this. This is something that, besides sugar, I'm very potentially excited about. And I think we're going to leave you with silver gold ratio. So let's go to there.
All right.
Okay, so trifecta, back to my trifecta of inflation. Silver to gold. Long history of when gold's outperforming silver. Gold is obviously rallying, as we have seen, for the reasons of flight to safety, lots of central buying. Really, basically, in times of uncertainty, people like gold, number one. And number two is there's even been rumors of gold-backed oil pricing by Russia, which would be really interesting. Very bullish for gold if that happens. But to me, inflation is measured by how well silver is doing versus gold. So right now, if you look at this chart that Geoff just put up, it's been trading just under 90. It says 9, but if you look at different charts, it tells you 90. It's like, I think it closed today at like 88.25, which means that gold is 90 times the price of silver, right? That's why people are saying silver is so undervalued compared to gold, because historically it doesn't really get much higher than that. And you had that huge move, obviously, in COVID. But besides that, mostly when it gets anywhere near over 950 or 90.95, if you're looking at a different ratio chart, that's been the top for gold. And it means silver can get some play. So this time now we're starting to see it turn down. What would interest me right now is if we break down, we decided to leave that moving average. And what is that moving average, Geoff? That's
It's actually 125. The black one's 125, which equates to about 6 months.
okay. So it's not one that I generally use, but it is kind of interesting that it happens to correspond with around that 880 level. So to me, if we start to see this ratio break down under 880, would probably, if you haven't bought silver yet for any reason, that might be a good time to really start a position in silver. If it continues to break down, and particularly if it breaks down under 8, that's what I've been saying in the media, under 80 or 8. then I think you're really on to something, not just with silver potentially getting to $40, $50 an ounce. Gold doesn't have to go down, it just can go sideways. But you're really, again, now with sugar, you're checking off the box on the second part of the trifecta, of course, the dollar being the third.
Cool.
By the way, how do we know if there's a recession? If silver starts to collapse, if gold can't go any higher, if the grains and this other commodities we've been talking about start to break down. It doesn't matter how little supply there is or how many tariffs are put on. Essentially, it is all about the consumer. And when people stop buying things because they're worried about a recession, that's you see it in commodities sometimes before you even see it in equities.
Yeah. 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 So another reason to keep an eye on these charts, these commodities charts, even if you're not really keen on trading them, they can give you a lot of insight.
But if you are keen on trading them, just hang out with me some more.
Absolutely. Keep an eye on your daily.
Right. Okay.
Yeah, which was great today, full of a lot of actionable levels. So if you're not getting it or you haven't read it yet, the daily for Monday the 17th, go grab it at the site.
Yes, and Erin go bra.
Oh, and happy St. Patrick's Day.
Yeah, exactly.
All right, I think that's a wrap, Mish.
Yes, definitely. Thank you, Jeff. Thank you, everyone. I hope this was helpful.
Bye for now.
Bye for now.